Stocks have been anything but calm in recent weeks as investors worry about the timing of the Federal Reserve's looming rate hike to the economic weakness in China, the world's second largest economy. Here with a look at what's next for the markets is Liz Ann Sonders, the Chief Investment Strategist at Charles Schwab. And Liz Ann, it's great to have you back.
Thanks for having me.
So what do you make of the volatility we've been seeing? How long will it last?
The short answer is I don't know. I think the type of volatility we saw when the correction first unfolded in August, where you not only saw the spike in the VIX, but there's another index called the Volatility of Volatility. It's the VVIX. That broke records on the upside. I don't think that type of volatility is likely to persist. I think we're going to see bouts of it, though, that are very similar to what we've seen recently, at least until we get some sense of if and when the Fed's going to move.
All right, we'll talk about the Fed in a moment, but is there a playbook for investors during these volatile times?
Well, there isn't a perfect playbook, of course, because if there was, then this would be a very easy game we're all trying to play here. But I would say one of the reasons why we were cautious heading into the highs in May was because you were seeing a lot of deterioration in the internals of the market. Breadth was deteriorating. We were experiencing what's called distribution, where stocks were moving from stronger hands to weaker hands. It was masked by the averages being at all-time highs, but the underlying deterioration was of note. I would say what to look for, to the extent we're in some sort of bottoming process, is the opposite of that. Look for weak days, but where you start to see accumulation, where the breadth improves, where stocks are moving from weaker hands to stronger hands, where the individual constituents start behaving better than the averages overall. That, I think, would give you a good sign that maybe we're trying to find a bottom. We haven't seen that quite yet.
Yeah, and what do you think is needed to soothe the markets? Is it just that first rate hike from the Fed, or is there something else?
Well, not only do I think an initial rate hike would be that soothing factor, just to get it out of the way, have that sense, okay, we no longer have the uncertainty as to the start point. But I have the view that the Fed, having kept interest rates at zero for as long as they have, has been a depressant from an economic perspective. Not only just in the confidence channels, you continue to treat the economic patient like it's in the trauma room, then that's what the public is going to perceive too. But I also wonder whether it would push fence sitters off the fence. And what I mean by that is 0% interest rates in perpetuity sets up a deflationary mindset. Why would I bother to fill in the blank, invest, borrow to expand, if I have that opportunity down the road, and if our central bank is not giving us a message that they're confident in the economic recovery? And I just wonder whether that takes people off the fence. Businesses stop borrowing just to buy back stock, and they actually look to invest longer term. Even if you're a potential home buyer, you say, boy, I better move now before mortgage rates start to go up. So I think there's that channel too that's at least worth consideration.
So on that note, did it surprise you that the Fed kept interest rates unchanged last week? And when do you think they will raise rates? Are you in the December camp?
It didn't really surprise us because you were seeing financial conditions tighten even before that, as a function to a large degree of the dollar strength. You had seen the weakness in the global economy. So it wasn't a big surprise. If I had my choice, I would have liked them to move, but it wasn't a huge surprise that they did not move. What I think was a bigger surprise was that they didn't move and also issued a very dovish statement. The expectation, ours included, was that if they didn't move, they would be much more forceful in suggesting it was probably coming this year, and they did not do that. I still think there's a decent chance it comes this year, but they've surprised us in the past.
And the statement also referred to global financial developments, which was largely referring to the weakness in emerging markets, particularly in China. What's your take on what's going on in China? Is it really that bad that it would put the global economy back into a recession?
So we don't know yet how bad it is. They're clearly slowing, but quite frankly, that's not a news story. And it is, to some degree, part of their 5-year plan to shift their economy from being investment, manufacturing, export-led to more consumption-led. And that naturally brings with it lower growth. So I'm not so sure that this was a new story that required our U.S. central bank to suddenly act as if it's the central bank for the rest of the world. Nonetheless, they specifically cited it. So unless we see some calming in those forces, then I would guess they stay on hold.
All right, Liz Ann, a lot of issues we'll be watching. We'll leave it there for right now. Thanks very much for coming in.
Thanks.
I'm Scott Gamm, and you're watching The Street.